Hey guys, welcome. Thank you for joining in. I have got 7:30. I think we'll just jump right into it and um, well, I guess we'll just dive right in. I do appreciate it when you call in. It's always grateful. I know most people are harvesting, so there's going to be lots of people watching this on the recording later. And uh, if anybody has comments or questions, use the chat function and I will do my best to get them answered for you. Okay, so let's dive into the balance sheet here just a little bit because I've been struggling a lot with just the bullish fundamentals that are around the corn market. You know, beans are what they are. We know South America's planting a bunch. We know that there's export issues and we know that there's problems. But corn, I just can't understand why corn never has um, rallied much higher, given the war, given the wheat stocks, given all of the bullish fodder that's out there. But I think I'm starting to really understand why the market is doing what it's doing, and I think that we can start to assume that the market is actually right, and we're actually building premium into a much more bearish set of fundamentals that might exist. So let's walk through that, okay? So this line right here is oh, come on, computer. This line right here represents the September WASD, okay? And that's also in this column, and you can see each of the previous months and how the USDA has managed the WASD, okay? And what matters in this business is always the ending carryout. The bigger the ending carryout, the lower the price. The smaller the carryout, the more bullish the price. And what's really important is the trend, right? Which direction is the USDA sending this carryout number? Well, supporting this bullish argument, you can see back in May, in July, we had a much larger carryout than what they gave us in September. And yet, since the September report came out, corn has gone exactly nowhere. So why is that? Why are we getting more bullish with a smaller crop and not going anywhere? Well, if you start to read the harvest reports, there's a pretty strong argument that the yield is actually increasing and that the USDA has printed its smallest number that it's going to print. And I think that argument is really picking up credibility as the combines start to roll. Now, the USDA gave us another bullish impetus here last week with the quarterly stocks report because they took the beginning number here, okay, this 1525 number, and they actually decreased it to 1377. Now, I'm going to put this number in here, and I want you to watch what the carryout does, okay? So if I take this and I go 1377, and it changes everything, our stocks to use drops significantly, and our carryout drops to just 1 billion bushels. Let me drop it over here to the bearish case, and same thing. We just get more bullish all the time. I mean, if our yield were to drop to 167.5, and with those stocks to use, man, our carryout is 661 million under 5% stocks to use. That is all-time highs. That's worse and that's tighter than we were in 2012. So if the USDA is printing these numbers with the risk that this is true, then why in the world have we not gone up? I mean, honestly, this is enough to have sent the market to $8 by itself. 7.5% stocks to use is way too tight, okay? But we're not doing it. And I've really been struggling with why we're not moving higher. And the reason, of course, is what they're doing trend-wise with the demand. So here's the use, here's the total use, and I lump these into one big category. You know, the USDA breaks it down into ethanol, feed and residual, and exports. Okay, and they took off quite a bit last month. Okay, so that immediately said to the market, oh, our yield might have come down, and our stocks are down, but their forecasted demand is down. So maybe this carryout number is not what they say it is. Now, what I've been studying this morning and listening to people talk about is the fact that number one, the yield might come up higher. StoneX was out yesterday with an October survey of 173.9. And then if you start to look at exports and ethanol, and you realize that the dollar has rallied significantly, I've been saying, hey, the dollar has rallied a lot. It's rallied like 18% since August, and oil has come off $40 a barrel since in that same time period. Why has corn not followed it? Why has it not gone down? Well, the reason is because corn's been discounting this higher number. But what if it starts to discount a staggeringly bearish statistic, which is that a 1% decrease in U.S. gasoline consumption is equal to 50 million bushels of decreased corn grind? And the data that has just come out recently is that gasoline usage is down over 6% year on year, which is a 300 million bushel decrease in ethanol usage. And so right here, the USDA is starting to get to it. But then you look at the feed and residual, and you start to realize that that we're slaughtering more cattle because of the drought, which is bearish corn demand, somewhere in the 300 million bushel mark, and that our export usage with the currencies could drop another 300 million bushels. So that's a total of 900 million bushels off of this number. So if I do that math real quick for you, and I take 14,525, and I take off 900 million bushels, all of a sudden, look what happens. Our stocks to use is out to 15%. We have a 2 billion bushel carryout. And friends, we're below the cost of production if that happens, because that's more corn than we need. And I think that that's what the market is starting to digest and starting to look at. Because even if you drop the yield and you take this number to 13,625, you still have way adequate. Now, this isn't cost of production, but this is definitely not 650 corn. This is much, much lower. So this is why we're pretty aggressively hedging. And we're not hedging because we agree with this number. We're hedging because we can't figure out why, with this market setup that we're currently trading, why we haven't blown up higher. We've rallied from 560 all the way to 7. We've tested it 1, 2, 3 times. I really thought yesterday we might be seeing a breakout if you looked at the substructure. But this market is telling us that we're consolidating into this big wedge. And here's the problem, is that if you look at this point right here, which is a high of 683, and you just draw a horizontal line, and I'll mark it right there for you. Okay, so this horizontal line, let me mark it again. Boom. This horizontal line is at 683 3/4. Anything below that was going to imply that we're going to break this lower trend line. You break this trend line, then you fall down to this base channel. I think that corn could accelerate much lower, much faster, and we're going to see a move all the way down to the 480 mark. And if that 480 mark is actually consistent with a carryout in the 2 billion bushel mark, or maybe even somewhere between 2 billion and 1.5. So there's the reason that the market has not been selling off is because it's actually been building premium through this sideways consolidation at the risk of, and it's building in the possibility of smaller yields. But once those get confirmed, and as we confirm demand destruction, then corn's got nowhere to go but down. So that's the bearish case. Okay. Now let's look at soybeans, because they're not any better. I'm not going to go through the balance sheet with soybeans because I don't have time, but I talk to people all the time that say, oh my gosh, we have negative carryout. Well, we do. We could, in theory, have a negative carryout, but only if you assume that that our demand is high. And if you start to see similar demand destruction with soybeans as you are with corn, then our carryout is way understated. And if in fact China, South America has enough soybeans to supply China, and our exports decrease by a couple 100 million bushels, then you have an extreme surplus of soybeans as well. So the bean market has been leading this way for a while, right? You've got this downward trend channel. You have the same wedge that corn is currently consolidating in. We broke it the other day. We threw back. We broke it again on Friday after the market got confirmation of additional stocks. We broke this downward trend line. We broke the base channel that came through here. Yesterday we rallied and tested the bottom side of that. I think if corn or if beans keep testing yesterday's low, they're gonna continue to work on lower. With this count, with this setup, I see nothing to change our mind that 1333 is a first target for sure. I think 13 is a no-brainer because that would finish this wave count. But you can't rule out a move all the way down to 12 or even 1150 on soybeans. With the demand destruction that's been happening. And what will break soybeans faster than just China not buying? Corn breaking as well. Because if beans and corn think that they're both believe that they're oversupplied, then they're going to race to the bottom, and you could see that accelerate to the downside very, very rapidly. So I see no reason whatsoever to lift hedges. See no reason to make any adjustments there. I think you're looking lower in corn. I think you're looking lower in soybeans, and I think that that's going to also drag our friend wheat with us. You know, wheat's been really, really tough, and all week long it's been probing at these three. We've probed the last 3 days at this $10 1010 level. What is 1010? Well, it's the high of this bar. It's the high of this little consolidation range, and it's the low of this this long consolidation range that held all through March. Well, Putin is crazy. Yes, he's completely crazy, but the market knows he's crazy. Yes, we know that all of the exportable supply is in Russia. Yes, we get that. Yes, we know that we are that we have a drought in Argentina, that we have a drought here. We know that. That's why we've rallied all the way up. That's why we are where we are, because we know all those fundamentals. But the inability to break this, and with corn we're starting to work lower, tells you that you have to start to look lower on wheat as well, and just based on the overall fundamentals. You know, everyone's talking about, well, the dollar is breaking. It has broken. And everyone says, well, this break should be enough to catapult the grains higher. Well, the grains didn't decrease through the entire rally, right? So since August 11th, the dollar's gone from 104 all the way up to 115, and corn didn't break a bit. Corn didn't move lower at all. We're holding near $7. So a dollar break doesn't necessarily mean that exports are going to pick up and that that corn will go up because of it, because the reverse didn't happen either. We didn't go down with a rally. So corn's been pretty much non-responsive to the dollar thus far, and it's also not been following oil greatly either. You know, since August, we've seen oil drop from 95 all the way to 75. Since June, we've seen it drop from 110, and corn hasn't gone with it. Corn is still trading right at that $7 level. Now, if all this reverses and the dollar does crash and oil does rally and the stock market rallies and inflation comes back on in massive fashion, then yeah, commodities will probably rally, but that's just going to spur the Fed to more action, right? They're just going to become more active and hike rates faster. Which I think just resolves itself even more negatively. And then you have to start to discount, and this is the most bearish thing of all, you have to start to discount larger crops moving forward, and that we may have built in the bottom of supply. And I know those of you that are listening that have total disasters on dry land, and this year's corn crop didn't pollinate, and basis is screaming hot, and all those things are true. But that's in our backyard, right? You have to look at the bigger picture, and you got to look at what's happening in Iowa and Illinois, and you got to recognize that the crop is not that bad, and we're in pretty good shape. And what if Brazil hits a big one, and then what if we hit another big crop next year? So I think lower is the direction that we've got to look. Okay, so I'm going to review this here real quick, and we're going to talk about positions here just a little bit. Where we are currently is we have 50% of our bushels sold in futures from this level right in here. I think our actual sale is 66. So we're selling it as we moved into this range. We started selling it. We have the other half of our bushels hedged with 670 puts, and we've been selling $7 calls. Now, yesterday we came out of those calls just in case we do blow out the upside. I think today we're going to resell those and keep that premium in. So we're hedged 670, and everything's right around that 670 mark. And as we do work lower, I see no reason to lift those hedges unless some piece of fundamental news comes higher, or comes to light. So if you don't have basis set, if you don't have protection on, I think you gotta have it in place. It's fun to talk about higher prices, but the reality is that at the moment it's not really in the cards unless something happens and we start breaking these highs over here. And if it does, great, we're going to own it and we'll go with it. But until that happens, that downside is very, very real. Now in soybeans, we are long 1380 puts, and we're short futures on half our crop from this 1450 level. And that's right where we want to stay. I see no reason to adjust that whatsoever. And I don't think that we want to go ahead and sell next year too, unless I don't think we want to do that quite yet. I think we want to wait and see if we don't get a little bit more of a bounce. If we don't get that here in the next day or two, and if we start to roll over, then we're going to start putting protection on further out. Because the sad thing about bearish fundamentals is that once supply is there, that's going to act as a lid against rallies until you get into another either extreme demand situation or supply shortage. So once they fall, they're going to sit there and consolidate sideways, and they're not going to rally back the way that we have been accustomed to for the last 2 years. So I hate to beat the bearish drum as hard as I'm beating it today, but what I really want everyone to understand is that the fundamentals do exist to send us lower, and the market can and will price that in at some point. So the downside risk is very, very real. I'm not saying we can't go higher, and I'm not saying we can't move to all-time highs. I'm not saying that can't happen, but as we see it as of October 5th, something has to change fundamentally in order for that to be a catalyst to work on up higher. And we just don't see that on the table as of now. All right. That is what I've got for you this morning. That's 18 minutes. I know that's way more bearish than anybody wants to hear, and that's more bearish than I like to be. But that's what we got to do. We got to call it as we see it. I hope you guys have a great week. There is tremendous risk in trading futures and options, and you should only do so in light of your own financial condition. If you have questions and want to talk through positions, please call me, and we will be happy to help readjust positions and get you to where you want to be. I hope you guys have a great week. We will talk to you next Wednesday.